So this is going to be a video, quant trading for dummies. So if you remember these book series, it was like for dummies. It was basically just dumbing things down so you can fully understand like the fundamentals. So this is what this video is going to be. So in this video, we're going to be building a quant trading strategy that even your grandma could trade. And the goal is you're going to find a generalized statistic that we can use to trade. And when I mean by generalized, it means that there's a statistic or a pattern that has persistence, that it's generalized, that you can use. So you see it in your in sample and you see it in your out of sample. But we'll go into more detail on that. And the condition is that because, this is for dummies, that we just use like basic math. Because there's this like misnomer that you need to be like a math Olympiad to build a quant trading strategy, but it's further from the truth. So essentially we're just going to as long as you just know basic arithmetic and the arithmetic mean, then you're good to go. So what we're going to do is also as well not use any machine learning or any advanced mathematical modeling. And the key thing is just to show that simplicity is better than complexity. So the idea is that you don't want to build like a machine learning model with like 100 features. And I'm always advocating like very simple models. You're less likely to overfit and better to generalize. And I just want to show that, you can build like just a basic a profitable trading strategy just using a basic statistic. So this is what we're going to do. We're just going to find like a generalized statistic. So what we're going to do, first thing, is we're going to load the data. And this is like the biggest hurdle. It's just to get your data into a data frame, like a so you can play around with it and analyze it. So if you've got this far, like you've got your data into a pandas data frame, you've basically covered 75% of the hurdles. Now that's like the hardest part, is just the logistics of getting the data and cleaning it and processing it, right? So for example, here I've got like a Bitcoin dollar, 12-hour time series. So each row represents like 12 hours. And you can see here, it's got it from 2023 to just yesterday, I believe. So that's the data that we've got. And now we're just going to analyze it to see, like, is there a pattern that we can use? Just using a basic statistic. Remember, we're not going to use any machine learning. We're just going to look for a generalized statistic. So the first thing we need to do is just to check the column types, because I just got a sneaky suspicion that so basically T is your open date and closed date respectively. I just want to see that T and capital T are date time respectively. So what I'm going to do is just do data types. Okay, so you see that the objects are not a date time. So we're going to build a trading strategy based on like a time pattern essentially. So for us to do that, we need to convert it into a date time object. So that's what we're going to do next. So what we're going to do is convert it into date time columns. So maybe if I put a header here to say convert to date time columns. Okay, so what I'm going to do is, so we're just going to update, oops, what's going on here? What is this? This looks like some AI they've added to it. Okay, so we want to update T. At the moment, it's just I believe it's just a string, but we want it to, because we're going to extract, like, say the day of week. So we need to convert it. I'm just going to let AI generate it, but it's not exactly what I want. And we're going to do exactly the same for the other column. That's the closing date. Okay. And yeah, I actually do want to, okay. So now we've got it like sorted into the correct data types. We've got our T and capital T, which is open and close respectively, as a date time column. So we're good to go. And just maybe if I just explain all these columns as well. So you've got, maybe if I go up here. So you've got the sim S, which is the symbol that we're trading, which is Bitcoin dollar specifically. The interval, the open, close, high, low. This is like very common basic pricing data. And you've also got the trading volume. I think that's the notional value, so that's in dollars. And you've got the trading quantity as well. So, but we're just going to just focus on basic price movement, just the close. So now we've converted into date time. Now what we want to do is to add a date. Actually, what we'll do as well was we'll add like an index. It's not strictly necessary, but I just like to do this just as a good practice. So we're going to add a date time index. Okay, and to do the index, we do df.set index. It's already got the T in place, and then I'll just print it. You can see now that this column is not aligned on the same position. So this is just to indicate that it's an index. Okay, so we've indexed it, and now what we can do, what we need to do, right? And this is very important. So is to add the returns. So I think this really what distinguishes, like say amateur traders from, like, say, professionals, right? Is they look at like price movements, and so they look at the returns and not the deltas, essentially. Because, like, for example, if it moved by $10, you need to know, okay, did it move from, let's say, $10, like did it move from like $100, or the price moved from like 20? Because you need to factor in the scale. So this is why we want to look at returns. So let me just add returns. Oops, I didn't add that as a text column. So let me just cut that and copy that. Okay, so this is, I'd love to use log returns. There's some really good properties of using log returns. If you've seen my other videos, you've probably seen, but because we've got this condition that we can only use basic math, we can only use like arithmetic, and that's all we can do. Like, we just use the sum function, and that's it, the mean. So we unfortunately can't use log returns. But so essentially how we're going to do this is we're going to just look at the percentage changes. So that's essentially what the returns are. It's just the percentage change. So what we're going to do is then going to model this, because, like, for example, if we just did it like the price change, like deltas, essentially just like taking the difference, like, for example, Bitcoin, like, for example, in 2023, let's say like a 200 price movement, maybe, I don't know, 5%, but now maybe like that same price movement may only just be like 0.5%. So it's very important to know the scale, right? So, and this just makes it independent, essentially. So this is what we want to do. We want to do C, percentage change, and what else do we want to do? We just want to make a copy of it. Drop the NA, because the first row is going to be null. So we just want to, and I'm just going to make a copy of it as well. Okay, so that's our data. So we've now got this closed return, and this is what we're going to analyze. So you can see, like, here it moved by this percentage. If it's negative, that means it moved down. If it's positive, it moved up. Okay, so we've now got it in the return for it, and now what we want to do is to add a date time column, because we're going to analyze like by like a time pattern. Okay, so that's the next goal, is to add date time columns. Okay, so what we're going to do is just going to add day of week. Okay, and that we're going to get that from the index. So we do index dot day of week. Okay, so that's how we set it. But just what I'll do is I'll just show you what it looks like. Okay, so just a very important note is that Monday, it starts from 0, so Monday is 0. So for example, this is actually that's Friday, right? So that's like, and that's Saturday and that's Sunday, right? So it's not so it starts from 0. So that's just an important detail to mention. Okay, so we're just going to have a look. Okay, is there any like sort of patterns like based on the day of week, right? Yeah, we could use machine learning, but we're just going to remember we're going to keep this very, very simple. Just you find like a basic statistic that we can use to trade. So now we're actually going to start, I've done all the boring stuff, essentially just prepping it, just like, I don't know, like a chef, like you've done all the preparation, right? That's not the fun part. The fun part's the cooking. So now that's what we're going to do now. So I'll even put that in the title, Cook Quant Trading Strategy. And so really another part of the video is just to show you, like, don't over engineer, because I've had a few messages and, a few people are trying to like build neural networks, really complex, like with 100 features, and in my opinion, it's over engineering, and you can, simplicity is the best thing here. So what we're going to do, maybe I'll just put the goal is, just to reiterate, is to find a basic statistic that is generalized. And when I mean it's generalized, it means it's a pattern that has persistence throughout the whole of the data. So like I've got like 2023 to 2026. I need to find a pattern that is persistent throughout the whole of that time period. Okay, and then that I know that, okay, it's generalized well. And then the second part is to actually build find the statistic and then build a trading strategy based on that basic statistic. Okay, and don't worry if this is not making too much sense at the moment. Once we actually cook, then we'll understand. So the first thing I want to do is I want to group by day of week. Okay, and what this is going to do, and then I want to aggregate. Okay, and I want to aggregate by the close return, and I want to aggregate by the mean. So I want to know, like, what's the expected close return on average, and then the count. Like, I just need to know for each grouping, like how many data points or trades essentially is there. Because for example, if there's only like 2 or 3 data points per grouping, then we can't say like, okay, I'm able to run this, the statistical significance of it. Okay, so you can see here that we've got like for each like partition roughly around 312 data points. Okay, and you can see here that I'm just gonna like look at this, right? So I can see like the strongest is like where the mean, where it has the strongest price movements, just looking at all the data. It's like on a Monday, on Wednesday, Thursday, and also Sunday, right? And this is like, so we're gonna have, but we can't just trade based on this, right? Because it could be that this pattern is not, we don't know if it's generalized, right? So what we need to do is like partition it into like what's called an in sample and an outer sample. And so this is what we're going to do now, right? So we shouldn't just trade based on this statistic, right? Because we don't know, like, for example, it could have had really bad performance throughout the whole of the data point, and just like the last few days, it just had extreme price movements, right? So we need to see like, okay, is this pattern like how generalized is this pattern? So so that's what we're going to do now. So before we can do that, we need to do this. We need to split it, like just do like a basic statistics. And that what's also you do in machine learning, which is you split your data into in sample and outer sample. So we're gonna do this. So we're gonna split the data into in sample and out of sample. Okay. And to do that, we're just like it's actually just very easy to do. Like so, what we need to do is find the index, and we also need to just we're going to do this. We're going to take the length of the data frame. Okay, so that's the length of the data frame. We're going to times it by 0.7 because the first 70% is our in sample, and then the last 30% is our out of sample. So we're going to analyze the in sample to see like, okay, is there a strong price movement somewhere? And then to test it out on the outer sample. So yeah, then this is also is an aggregated statistic, right? So we've got the I, and what we're going to do here is do in df, which is our in sample. Actually, I'll call it, yeah, I'll just leave it at that. Okay, so we're going to take the data frame, and we're going to just say I. Oh, out df equals, and then we're going to go take the remaining from I onwards. Okay, so that's our code, and so we just run that, and I just like to do a quick empirical check just to make sure that it's split correctly. So you can see here from 2023 to 2025 17th. And now if I do my out df, my out of sample, they can see that, okay, it's splitted it correctly, right? Okay, so we're going to basically just run we can see that it's run. Now we need to just find like so now our goal is to find our generalized statistics. So maybe I make a note here. Find generalized statistic to trade. Okay, and so now we're going to do exactly the same aggregation. We're going to okay, so we're going to do the group by, and you just while I'm doing this, I just want to say why we're doing this. So for example, I remember when I was trading like futures that there would like be certain patterns, right? Let's say on a Friday. This is way back a long time ago, but there would be these patterns, right, that would just happen, and especially like if you're doing like event arbitrage, like on what happens on a specific periodic event, you see these like patterns that just come out. They're just there. So, and this is what we're looking at. It's like, okay, is there any like strong pattern that has persistence? And this is what you can't see if you're just looking at like say these charts, right? There's just like all these like hidden statistics, and so we're just essentially just looking for them, but we're not using machine learning because machine learning is like looking at every single like for all trading periods, right? You could actually just filter it and then just like run the machine learning, but let me just do this. Return mean count. Okay, so this is let's look and see like, okay, the expected price movement on the in sample. So the strongest one is actually, if I'm looking at this, is on the Wednesday. That has the strongest price movement, and also on the Monday, right? So let's look at Monday and Tuesday in the outer sample, right? So let's look at Wednesday. Okay, so what we're going to do is then I'll just do exactly the same. I'm just going to actually just copy and paste it just to save time. Okay, so we just do this exactly the same code, but we're just doing it on the outer sample. Okay, so this is the aggregated statistic, right? And there's like 94 data points. There are ways to measure to measure the statistical significance of this, but this is out of scope. So, but I think roughly, just like as a rule of thumb, like it has to have roughly about 100 data points, you know, to be significant, right? So we're just there. And so let's have a look at on Wednesday, which is 2, right? So you see, actually, it has actually the same has the same mean, right? So we can potentially like just use this, like if we're just creating a quick one, we can just trade this, right? So what does this mean? Like how would you trade this statistic? So if it's a strong price movement in our in sample and out of sample, and it's a strong price movement, then we just know, okay, on Wednesday, we want to place a bet that it's going up. And that's what we can actually model this as well. So we don't actually have to actually trade it to see if it actually does work. We can just like back test. So that's what we're going to do. But we're going to do it against all of the data, right? Well, we could do it on both individually, but just to save time, we're just going to do this. And maybe I'll just detail what our strategy is. Okay, so the strategy, so I'm just going to make a text here to say what our strategy is, just to make it super clear. So what's our cooked strategy? And remember, this has to be super simple that your grandma can trade it, right? Okay, so what we're going to do, maybe if I put in the next one. And the next one is, I'm just going to list all the details, right? So what is the statistic that we're going to trade on? And the statistic is that Wednesday has a generalized pattern that it goes up on average. Because we've taken the average, right, of the average price movement, right? So we've done it on the in sample and the outer sample, and we can see that it's actually got pretty much the same mean value, right? So that tells us that it's like generalized. Okay, so that's the statistic. Then now what we need to do is like, okay, then what's the signal that we're going to use? And the signal is to go long, and that's essentially. What this means is that you're going to make a bet that it's going up. And then, like, for example, if it was a bet going down, you say you go short. And if it's only on a Wednesday. Okay. And more specifically, maybe if I just go into more detail, like what you would actually do. So you would open a long position. Because this is 12-hour time intervals, right? So you would open like a long position. You can do it like this. There's actually multiple ways you can do this, but just to show you, right? So for example, you would open it at Wednesday midnight UTC, open a long position. Then you want to close this long position Wednesday at midday UTC. And then you want to reopen a new position, open long position still on Wednesday at 12 midday. And you may be wondering, okay, why you just keep the position open? You could actually potentially keep the position open, but because we're using 12-hour forecast like intervals, and essentially what you could do as well, which we're not going to do in this strategy, but you could reinvest. So this is like do the compounding. And this would significantly improve the performance, right? But because we just got to keep it super simple because your grandma's trading this, it just needs to be super basic. We're not doing anything super sophisticated, no like dynamic position sizing or we're just keeping it very basic because this is your grandma that's going to be trading it, okay? Okay, so that's what we're going to do. Open a long position, and then we're going to close a long position. Okay, so that should make it super clear. But so another caveat to this is that we're only trading on Wednesday, right? So, oh no, sorry, Thursday. That's when you close this. So Thursday at midnight UTC. And you say, why is it 0 and 12? That's because we're modeling it specifically on UTC and at those specific time periods. So we've got to keep it consistent with what we're modeling. Okay. So that's our so hopefully that's super clear, like what it is. It's like a super basic. And the beauty of this is that you could trade this manually and you could trade this automatically, and it would be quite easy to cook up. Like, yeah, you can trade this manually, right? You can just like, okay, if you're in a different time zone, maybe you have to wake up like, I don't know, like New Zealand, you would have to wake up like 6 a.m., right? Yeah, this is like the very basic trading rule, and this is very simple to code up as well. Okay, so that's, and now what we just need to do is like, okay, evaluate the equity curve. Let's say, okay, if we traded this statistic, what would we, like, how much would we make? And it's quite easy to do. So we need to evaluate the equity curve. So the first thing oops, I want to make that text. So the first thing we want to do is to filter the data just for Wednesday. Okay, so that's what we're going to do. We're going to do a filtered data frame, and then the data frame is we've got this predicate, which is, I might as well just let it complete because that's correct. Day of week equals 2. Okay, so that's our predicate to say like, okay, when it's Wednesday, that's what we want to, and just I always like to do is just make a copy of it, because when you add in new data to it, you don't get these like warnings and whatever, and you get this like data fragmentation. Okay, so, and I just want to print it out as well. So you can see that all of the, just to confirm that we filtered it correctly, because all the rows have day week as 2. So we know that works, okay? And now we need to add the essentially work out like, okay, what's our trade returns and add the signal. So that's what we'll do. So we'll add trade returns, and to do, oops, add this here. Okay. Right. So what we want to do, oops. What I like to do is just add the signal, just so we can see like, okay, if we went up or we went down. So if we were betting it to go down short, then it would be -1. But with this is going to we're going long, right? So the signal is 1. Okay. And what we're going to do now is to add a new data column. And this data column is trade return. And that is essentially the filtered DF. It's actually got the autocomplete. That's actually what I want. So that's, I don't mind completing it. So yeah, that's essentially the close return multiplied by the signal, right? Which is essentially just the close return, right? But imagine if this was, the signal was -1, then we need to negate the sign. Okay, so like for example, you're betting it short and the trade returns negative, then naturally you'd make money, so that you need to invert the sign, and that's so yeah, just in case it's not super clear. Okay, so that's the trade return. So now let's just have a look at the trade returns, right? So this is meaningless at the moment, so we need to and the problem is that we're not using, so the beauty of the log returns, which is basically the logarithm of the returns, is that you can have this thing called property called time additivity, and that tells you like also like if you're compounding. But because we're trying to keep it super simple, because your grandma is going to be trading this, that we're not going to do this. We're just going to use like a fixed trade sizing. And so the first thing we're going to do is to add the gross trade P&L for fixed sizing. Okay, so maybe if I do this add, okay, so add gross trade P&L. Okay, and to do this, we just take the, say what a trade size is. So I'm just going to, very humble trade size of just $100. Okay, and then we're going to do filtered DF gross trade P&L. Oh, I don't like using this, but that's actually what I wanted. Yeah, I was accidental code completion, but it's just looking at it, that's exactly what I wanted. So okay, so now we've got the, that's the gross, right? So the gross essentially is your realized trade profit, like the profit you make on the trade minus the transaction fees. And sometimes you can get quite excited because you've got like an amazing equity curve or amazing performance, but when you factor in the fees, that your edge is completely wiped off, and because it will amplify your losses and reduce your profits. Okay, so what we're going to do now is we can actually just visualize this gross equity curve, right? So we're only halfway there. So what we need to do now is to do filtered DF. We want to get the trade, what I call it, gross trade P&L. Okay, and I want to do the cumulative sum. So cumulative is just going to add them all up like a rolling, right, cumulatively, right? Because I want to know, like, at each time period, what's my equity curve, like how much money have I made or lost, and then I'm just going to plot it, right? And let's do that. So boom, this is where we go. So we start with like 0 P&L, right? And then, like, you can see here, like, it consistently goes up. There's a few bit of a drawdowns. It actually goes into negative equity, right, around the earliest points, but you can see that it consistently goes up, right? And there's a few like drawdowns, right? But just a quick, we just found this in like under 5 minutes, right? It's not bad, right? It's not trading a lot, right? So it's only on a Wednesday, so but it's profitable, right? And it's generalized. You can see that it's you can see this, right? So now what do we need to do now? So we can see that, okay, we can trade this, right? Because it's got this generalized statistic. What we want to do now is just say, okay, what's the gross return you would make? So what we need to do now, maybe add a column here. Add gross, like, what's the return that we would make? Because at the moment we just we want to just say, like, okay, what's the return we made on with our $100 per me. So we do this. So filtered DF. Then we take the gross trade P&L and take the sum, and then divide it by our trade size, which is our initial capital, essentially. So you see here that we have roughly about 73% return. So we start with 100 and we keep trading every 12 hours on a Wednesday. Okay, so that's like if we traded it like from 2023 to 2026, like essentially now. So some other things we I just want to show is just, okay, let's evaluate the win rate. And I would say this is a false metric that you shouldn't evaluate purely based on the win rate, because I just want to show that maybe this will emphasize this. So if I just looked, filtering strategies purely by the win rate, let's see like what the win rate will be. So filtered DF, and I just going to add a new column. I'm going to say trade 1. Okay, and I'm going to filtered DF gross trade P&L. It's already got the autocomplete. So you can see, like, okay, so if it's positive, if the gross trade P&L is positive, that means we won. If it's negative, that means we lost. Okay, and so now what we're going to do is to calculate our win rate, and it's quite easy to do. So you just take, because it's between 0 and 1. When you take a boolean, it's either 0 and 1. Then this is we can just take the mean. So trade one dot mean, and that tells us our win rate, right? So we only win 52% of the time, right? So it's like if you're like telling your grandma, okay, I've got your strategy, it gives you 74% over like 3 years, like without any optimization in terms of the strategy, because we're not doing like compound investing, we're not using any leverage. Then you told your grandma that it only wins 52% of the time. It's kind of counterintuitive, but yeah. So don't focus. I think that the key lesson here is don't focus on the win rate, right? It's the expected value. So yeah, and I know some people that have like very good strategies, very low Sharpe, very high returns, and they've measured statistically that they'll have some drawdown, but they know like it has a generalized persistence. Okay, so that's the win rate. And now what we need to do though is to factor in the fees, right? Because I just know that, okay, you haven't factored in fees. So because it's 12 hours, then I don't think the fees are going to play a big part. It's going to reduce the P&L, but I don't think it's going to be to a point where the edge is completely evaporated. So that's what we're going to do now. So add trade net P&L. And this is what's really important. And I also encourage you, don't trade on a very short time frames, especially what's called like taking strategies, because your trade, like the fees will just eat into your profits. So even if it's like you do have alpha, like essentially like you have a pattern that you can trade and it's persistent, you could still lose money, like, or just be very tiny amount, like, so even like let's say it's like 10%, but then with the fees it's only like 0.5%, and you just think, okay, is it really worth it just for when you factor in the fees? So that is, yeah, so the key thing is just you don't have to trade like in hours, right? This is just like every 12 hours. So what we're going to do is then add the trade fee. And the trade fee is 0.04%, which is, we measure things in basis points, which is like 1,000, 4 decimal places, okay? So this is 4 basis points, so I'll just put this in here. Okay, and now what we need to do is to do the filtered data frame. We need to add the entry fee, and this is where typically mistakes get made, because I've seen some people try to just calculate the trade fee and multiply like from the current price and multiply it by 2, but you need to factor in your entry price and your exit price, because let's say it shoots up by, I don't know, 20%, right? Let's just say hypothetically, right? Then you pay a fee on the price that they exited on. So your transaction fee when you close the position will be more, because let's say it's moved up by 20%, right? So this is what we've modeled is the round trip trades, the round trip. So the entry fee and then the exit fee. So the entry fee, because we're always trading the trade size, right? Like, which is, I think we defined as 100. The trade fee. Okay, and now we need to calculate the exit fee. And the exit fee is essentially what I need to do is to add the trade size plus filtered DF trade gross P&L. Okay, and then multiply that by, so for example, if the trade size was say $10, and let's say we pay 1 cent, and our trade gross P&L is also $10, so it's 20, right? So the fee you pay is 2 cents. So this is why it's important that you factor in the price that you close at. So now you just multiply it by the trade fee. Okay, and now what we need to do is calculate the total trade fees, or the round trip trade fees, because each row represents that you're opening and closing in that time on that row, right? And we're just going to say trade fees, and then it's just simply it's already got the open, right? So that's the trade fees. And now to calculate the net trade P&L, then all we need to do is okay. That's exactly what I wanted, which was to take the difference between the gross and then to subtract the trading fees from it. So yeah, and I've just seen some people trying to do this, right, which is like 2 times the trade fee times the closing price, which is not correct. So this is like a more accurate. Put that back. Okay. So that's now what we can do is, let's just print out and just see okay, oops, I've made a mistake here. Trade gross P&L. Because it's gross trade P&L. Okay, so there we go. So let's just have a quick look at the the first trade, right? So the entry fee was 4 cents, and the exit fee is well, if you rounded this down, then it'd also be 4 cents, right? So that's the entry and the exit price, and so the trade fees and totals, just if we rounded down to 2 decimal places, is 8 cents, right? So you just need to subtract the 8 cents from the gross trade here and that's exactly what it does, right? So, and because we're not trading on very short time horizons, it doesn't eat up into our alpha, our profits, right? And we can, we'll visualize this to see. So when we visualize this, it should be exactly the same, but the magnitude of the curve should just be different value, right? So this is what we're going to do now. So, and I just wanted to say, okay, what's the average? This is important, is that we want to know, what's the average, the trade fees? What's the average trade fees that we pay? So no surprise, it's roughly about 8 cents, okay? And we also want to see, okay, what's the average, I think I called it net trade P&L. What's the average net trade P&L? Okay, so on average, we're making 15 cents per trade. Okay, so this, shows us that we have an edge, right? So now what we want to do is to visualize the net equity curve, and that's the most important, right? Because that includes the fees. I'll just make a note factoring the fees. Okay, so filtered DF trade. Oh, it was net trade P&L. Okay, and then we're going to take the cumulative sum and then the plot. Boom. Okay, so you can see, actually what we'll do, I will print out the curve, the gross curve, and I just want to show you that they look pretty much identical, just the magnitude of the movements are just different, right? So you can see that, we still, there's still an edge here, right? And if we just, now what we'll do is just going to compare this against the gross equity curve. So if I do filtered DF and gross trade P&L, and again come sum dot plot. Okay, So you can see, like, really look at them like for like, they're like pretty much like identical, right? Very similar, right? But you just see that, you know, with the gross, it goes up to like $80, and this goes up to just like, say, I think it's roughly about just over 55, right? So you can see that, you know, when we factor in the fees, we've still got an edge, and it's obviously it cuts into our profits, but, you know, it's still, you know, profitable, right? So and maybe if we also, you know, if we, instead of trading every 12 hours, we traded every like 1 day, that potentially that could be like more, but you have to model this, right? It may be better, like, if you reinvest, like close every 12 hours and reinvest that to increase your position size for the next trading period. So yeah, so that's, and then also we want to say, like, okay, what's the total return, right? And that's the money shot. Okay, so we're just going to do this now. Total net return is then going to be the filtered DF net trade P&L dot sum over the trade size. And trade size is essentially just your initial capital that you use. Okay, and this is like also just using a fixed trade sizing, right? And you could dramatically increase the returns if you used compound trading. This is why I like to use log returns, because it naturally models like compounding. But because of the criteria for this video is like only using basic maths, then we can't use the logarithm function. Okay, so that's pretty much a wrap, right? So I've showed you how you can build a very basic, profitable, yet profitable quant trading strategy without any magic, without any machine learning or any like advanced mathematical modeling, just very basic, something that your grandma can devise. So maybe I just write a conclusion for this, right? So the conclusion. I need to typo. Okay, so the conclusion. So the first thing, right, was that you know, we've built a profitable quant trading strategy, and it's just using a very basic statistic. So we're not using anything super sophisticated, right? It's just, we've just looked at like a very just using the mean as well. So it's not like we're using like some advanced statistical measure, right? It's just the mean, right? And we can also, like, we've built a strategy from it that can be executed manually as well. So both automatically. Oh, let's just say you buy your grandma, right? Buy your grandma. Automatically and also manually, right? So with this one, it doesn't so because I've had a few people message me that are doing like manual trading, they like more want to go into the more quant trading, and so this is like something that you could use, right? Like if you're doing this manually, like, because you can just find that you could just do the data analysis. The only hard part here is just to find a generalized pattern, right? So and that's another key thing, right? We don't actually care about, like, for example, in econometrics, it's all about explaining like what's the causality, and with quant trading you don't really care too much. Okay, why does this phenomenon happen? Why does it always go up on a Wednesday? We don't really care. Like it's like good to like, but it's not like a prerequisite to trading this. We need to explain it. So I think that's another key important thing is that but and the thing that really, because I get a lot of people trying to, I've just seen people over engineering, like create super advanced math, and they can't see, like, okay, you know, they just think like if it's too simple, then it's you can't make money from it. So, and that's why I just want to say it's like so simple that your grandma can trade it. Okay, and I think another really key thing here is that I just used ingenuity to do this. All right, I don't need to be a maths genius to do this. You just need some creativity, some empirical research skills, like, and being able to. I think just being very comfortable with Python and data frame, and just some intuition, or not intuition. Just like some creativity, right, and just to explore, essentially, just experiment, right. So that's the thing. You just, I didn't need to be a math Olympiad genius. Okay, and and I would say, like, and just like, if someone's very curious and wants to build upon this, right? So put this as an exercise, is you could like look at some measures for maybe add this, or maybe remove this. It's like, okay, if you want to, you could do this, right? You could say, you could measure the statistical significance of the statistic, right? Because I haven't done anything with this, right? So you could just say, okay, and that's like for something that you could add to it to yourself, just to validate the statistic, right? So that's what we'll do, statistical of the statistic. Okay, and what else could you do? You could explore, like, for example, that's just the weekday, but there's all different things that you could do with this, right? You could, just like group it by hour, right? So it could be some patterns that, for example, it just naturally just goes down in the morning, like from 0 to 12, and so you could just find like that sort of pattern, and that would also be able to trade more. And what you could do as well is to find, like, so for example, this is only trading on a Wednesday, right? But you could find some other types of patterns and then compound them together to, so you potentially trade these sort of patterns, not just on, say, like on a Wednesday, on a Thursday, whatever. And and for example, this would be perfect if you're doing some form of, or you want to try and model some form of like event arbitrage. So for example, like if there's a periodic, like for example, like an economic periodic event, you want to model, like, okay, let's say some, I forgot what the event is called now, but let's say like every Wednesday there's like a report that gets released, right? And you want to, to analyze, okay, how does that affect price movements? Then, this sort of modeling can support you, okay, should you go long, or, how do you make money from that event? Because you can just group it into the time period. Let's say you just want to hold it like for a couple of hours, as in 12 hours, then this is what you can do, is just use this sort of like statistic to give you, just more confidence in your discretionary trading. Okay, and I think that's, maybe I'll just leave that as the first exercise. Okay, thank you very much, and don't forget to like and subscribe. Thank you very much. Cheers.